open our content sessions, we turn to one of India's most respected investment minds. Across cycles, booms, corrections, the turning points that have humbled lesser investors, this gentleman has built a reputation for disciplined thinking, conviction-led investing, and the patience to let wealth compound. There's an old saying that bull markets make you money, but bear markets make you an investor. By that measure, few in this country are more seasoned. This gentleman carries the battle scars of every cycle and the wisdom that only those scars can buy. Ladies and gentlemen, please welcome Mr. S Naren, Executive Director and Chief Investment Officer, ICICI Prudential AMC.
Thanks, Economic Times, for both inviting me and giving me a very interesting topic. I wish I had known about cycles when I started my investing career. At that time, I thought cycles was Hero Cycle, Atlas Cycle, and TIBS8 Cycle. And I went through the 90s not knowing the word cycle and made a lot of mistakes. So it was in the year 2008 that, thanks to internet, and I must thank all the media journals to help me learn everything about investing. Guru in this entire cycle story was Howard Marks for me. And the word cycle got embedded in me thanks to Howard Marks. He said cycles are inevitable and understanding and mastering them is of great importance. He also mentioned that cycles is not something you can get right all the time, and that is something he keeps writing about all the way. That cycle, just because you know the word cycle and you understand cycle doesn't mean you get it right all the time. And that is one of the most important things he has taught us, that just because you know cycles doesn't mean you will get everything. Once you know about cycles, it is automatic that you can make a decent amount of time in your lifetime. So instantly I want to go and explain to you where have cycles failed. If you look at the entire technology ecosystem in US, actually it has been completely structural in the last decade. And no one would have imagined that every company will become trillions of dollars, whether it is Nvidia, whether it is Google, whether it is Apple, whether it is Microsoft, recently Micron, etc. And there, cycles have failed and it has been structural. So could we have understood in 2021, actually Howard Marks actually wrote a piece saying that could this be structural? And as soon as he wrote, in the next 1 year, cycle played in that in US, and most of the companies which he thought was structural actually corrected, but again to rally. So do we believe that there is going to be cycles in this industry? The answer is, I still believe yes, but at the same time, you have to always think whether there can be structural pieces, because everything changes. I think today, most of us cannot live without computers, most of us cannot live without mobile phone. So certain things are structural. So cycles, it's not that if I told anyone in this room to live without a mobile phone, I think it would be the most important accessory that everyone cannot live without today. So that is structural. So you have to be aware that in technology, some amount of it is structural, but even within that, there is a cycle. So when I read all that I have to read about SpaceX document, the IPO which is going to happen this month, it looks like we are possibly towards a cyclical top, because something which very little profit is going to have a $1.75 trillion market cap and is going to be getting into an index very quickly because index provider decided to give them a fast entry. So do I still believe in cycle and technology? Yes, but I think that if you only believed in cycle, you would have missed the technology stocks. Where else have cycles failed? It has failed when I studied in IIMs in 80s, we read a favorite piece called Theodore Levitt's Marketing Myopia. His base thesis is that, you are actually doing a product. You are not selling a product, you are selling a category before that. So if you were looking at scooter, you were looking at urban transportation of two people. So can a scooter always exist? The answer is no, because end of the day, it can become a mobike, because end of the day, the need being satisfied is urban transportation. So something like a Chetak, which had a 6-year waiting period, actually disappeared in India after a few decades. And as most of you know, we used to spend in 80s and 90s years waiting for an OIT phone connection. It became a mobile phone because the need that was being satisfied was the verbal communication need and not landline phone. So when the landline phone became a mobile phone, landline phone companies actually did not do well. So the need that was satisfied is the verbal communication need. So similarly, the mutual fund satisfies the investment need. So can Economic Times, when they do an alpha summit for investment, can they ever go out of circulation? The answer is no, because the investment need can never go out of circulation. Can Madras Stock Exchange or Calcutta Stock Exchange go out of business? The answer is yes. Because it is not the investment need will never go out of circulation, but certain exchanges can go out of circulation. And this is something you have to always remember when you are running a business. You have to satisfy the need and not the product. The need of investment will never go away. The need of verbal communication will never go away. The need of urban transportation will never go away. And that is something we have to remember all the time. And that will never, so if you say there'll be a cycle and you're going to go back to landline phone, it's not going to happen. It will never happen. And that is these are the cases where cycles don't happen. And, over the last, in 2016 or 17, we got a chance to meet Warren Buffett as a group of 400 to 500 people in Delhi. So one person asked Warren Buffett this question: what did you learn in 4 to 5 decades of investing? He said that there are 4 times to invest in 4 to 5 decades. If you get that, then you have made it. So once that happened, we actually created, what we said was, let's create what are the different types of cycles in investing. So one we call the burst. Burst happens when there's a big global negative event, like World Trade Center bombing, Lehman, COVID. That gives you a once in a decade opportunity to buy. At that point of time, for people to get to buy is so difficult. We have tried it and failed. The second best is best time to invest. That is the year after that. That's a better time to buy. Sometimes 6 months later, let's say 6 months after World Trade Center bombing, 6 months after Lehman, 6 months after COVID. That's the best time to invest. If you invest at that point of time, you can make very good money. Burst is of course the best time to invest. Best time is also a very good time to invest. The third time is boring, where one set of investors are buying, another set of investors are selling. Like today in India, where FIs wake up every day and sell India, and Indian institutions like mutual funds buy every day. So in that period, if you do, you won't lose money, but you won't make very big money. That is the current situation. It's a pretty boring period because every day you wake up, you see FIs buying, selling, and locals buying, local mutual funds buying. That we call boring. And that is the period we are in today. And that is somewhere in the middle of the cycle, as what Marx calls it. The fourth is a boom, where, where mutual funds are also buying and FIs are also buying. There are years like that, 2006, etc. And in those years, if you buy, you will not normally make money in the long run. And the last is, if you call a bubble, where, you can make out a bubble. Something like, in January, for the first time ever, the amount of money which came into gold ETF and silver ETF crossed mutual funds in equity. That's a sign of a bubble. And automatically, you lose money. So the investors who invested in gold and silver in the world, they lost money. In India, it was moderated because of the customs duty increase. But you will know that. You can see a bubble when in front of your eyes, like 1999 IT, 2007 infrastructure. Then you have a chance of losing money. So today, as we speak, we are in a situation where you can make moderate return when you invest. And that is the situation because we have what we call a boring cycle. And because FIs are selling so aggressively at this point of time, and domestic institutions are buying so aggressively. And you can see it. So if you look at gold, for example, look at the move that happened between 21 and 26. And in January 2026, you know how silver moved. We used to go all over India for a specialized investment fund launch. No one wanted to hear us about specialized investment fund. They wanted to hear us, what is our view on silver? Every day, every colleague of mine was only asked one question: what will happen to silver? And if that kind of a question is asked, it means that you are in a bubble. And if that is happening to you every 2 hours, and everyone feels there is a fear of missing out, then you know you are in a bubble. And the chance of losing money is very high at that point of time. And why does it happen? I do not know. But very, very often it happens in different asset classes at different times. And you can see it. Like today, for example, we had a call by a foreign broker at 8:30 in the morning. We have one foreign broker talking to us. He was telling us today in Korea, today people are taking loan against their insurance policies and buying two stocks called SK Hynix and Samsung. And in Taiwan, people are taking personal loan to buy semiconductor stocks. Normally, such things mean that you are in close to a bubble. Because end of the day, if you start taking loan against insurance policies to do such things, that defines what you call closer to a bubble. And you should look at the SK Hynix chart. The only difference is, as a fundamentalist, you think SK Hynix is trading at a 10 PE, but you should look at the chart of SK Hynix. You look at the chart of Samsung Electronics. If you look at these charts, you look at the chart of Micron. And one of the lessons that we have learned over a period of time is look at this chart. This chart of silver will show you how the chart becomes parabolic. And in a bubble move, it is always a chart like this. And when you see a chart like this, if you gather the guts to operate against it, you normally make money. But remember, you will be one of the few people, because why the chart is so parabolic on the upside is because there are few sellers and many buyers. So if you are one of the few sellers, you have a good chance of making money in a cycle. And for example, take real estate. In 2012-13, we used to go to Gurgaon and Delhi. Everyone there wanted to buy under construction property which was going to get delivered in 2020. And they thought that it was Midas at that point of time. Those properties never got delivered, neither in Gurgaon nor in Noida. And, for 7 years, imagine for 7 years, the sector didn't do well. And then it bottomed out. So people ask me, how do you look at real estate? And when they asked us this question, and spent a lot of time on, we looked at it and said that the best way to look at real estate at times is look at rental yield and compare it to borrowing cost. So now people have asked me, in India, in Bombay, rental yields are going up, mortgage interest rates are reasonable. So I do agree that in Bombay right now, because of too much of redevelopment, this model may not work very well in Bombay at this point of time. But in normal markets where there's not too much of redevelopment, this model works much, much better. That you compare rental yield and mortgage interest rates. But if there's too much of redevelopment, like what is happening in Bombay at this point of time, should we use this model? This is something that we are brought to think about. But otherwise, if you look at 2013 and 2020, when there wasn't so much of redevelopment, mortgage interest rates were very high in 2013. Rental yield was very low. It told you real estate was expensive. In 2020-21, mortgage interest rates were very low. Rental yields were much better. So real estate was much more affordable in 2020. And that is the way to look at real estate cycle, which is a more difficult asset class to look at cycles from a point of view. Because in equity, you've got all these indicators which most of us know, which is price to earnings, dividend yield, etc. But in real estate, these cycles are much, much more difficult to understand. So if you look at it today, look at KOSPI, that is the Korean market, it's gone up 179%. And when something goes up 179% and silver went up 230%, and whenever you have a situation where anything goes up 100% and more, you should start becoming careful. If anything goes up more than 40% per annum CAGR for 5 years, you have to be careful. If anything goes down more than 50% in a year, you have to start looking positively. If anything has delivered bad returns for 10 years, you have to think positively. The only case where it took too long to recover was Japan. In 2024, I had a chance to visit Japan multiple times. I used to tell them, for 34 years, your market has not delivered. Why are you investing so much outside? But I could never convince any Japanese asset allocator that their own market was cheap. In their own market, they used to get an FD return of minus 0.1% or minus 0.2%. Their banks were trading at a dividend yield of 4%. So I used to tell them, why are you investing in your bank FD at minus 0.2%? Why don't you buy your bank shares at 4% dividend yield? They just could not get themselves to do it, because 34 years of no return in equity meant that they were so traumatized that they could not buy that dividend yield of 4% in banks against deposit interest rate of minus 0.2%. So they chose to keep their money in banks. But the last 2 years were very good. But I was lucky, because in 2017, also the situation was the same. At that time, rental yields, dividend yields were slightly lower. But it didn't work from 2017 to 2024. But it's other than Japan, normally, if you have a decade of no returns, it's very positive. So in US, for example, when we launched the US fund in 2012, there was 12 years of no return in US. It was one of the best times to invest in US. Brazil had given 1 decade of no returns in 2024. China had given a decade of no returns. When you see a situation of no returns for a decade, it becomes a powerful buying opportunity. Because after a decade, what happens? People just give up. And then that becomes a powerful buying opportunity to actually invest at this point, at different points of time. So what I've said, this is very easy, but 2002, most of the stocks in India had dividend yields many stocks in India had dividend yield equal to FD returns. So it was not very difficult for people to invest in equities when you're getting in equities dividend yields higher, equal to FD returns. In 2007, that most stocks in India which had no earnings and they had earnings potential, after 6-7 years, they could raise money in equity. It looked clearly like a bubble. If you had put it at that point of time in gold, you could actually make very good money till 2012. In 2013, 5-6 year returns on equity and small caps had become zero. So again, you could have allocated to equity, and it worked very, very well till 2017. So you might tell me this is theoretical, but frankly, it is not too difficult to buy in 2020 in equity, because in 2020, equities had become very, very cheap. And in 2022 or 2022, gold, silver had given no return for almost a decade. So frankly, using these principles looks difficult, but frankly, it is not so difficult to actually look for extremes to put big money. And actually that gives you very, very good returns. So people ask me, does it work in sectors? It does. So if you have telecom as an example, if you see a sector where the number of entrants are very few and the number of exits in a sector are very, very large, that's a very, very powerful positive. So if you see a sector where there are too many bankruptcies, you have to look at it very, very positively for the strongest company in the sector. And if you have a sector where there's no one willing to invest, you have to look at it positively. You take telecom as an example. Go back 5-6 years. Finally, you are in a situation where all the people left and there were just two people. But if you had looked at those two people, you knew those two people had a role because all of us were so dependent on mobile. In 2007, the number of new entrants in power were so many because there was a company called Jindal Steel and Power which made so much of money in merchant power that everyone got into it. But finally in 2017, everyone started to go out of it. So people who made money were the people when all the people exited the sector. And when people exited the sector, you invested, you actually made good money. In metals, most of the people exited the sector, and that's why the remaining people in the sector made very good money. So if there are too many new entrants in a sector, you have to be careful. If there are too many people saying, I'm getting out of this business, you have to be positive on that sector, which is actually because the number of new entrants who enter the sector reduce the margins of the remaining players in the sector. This is how you have crashes. And because at the end of the day, the number of players who come, that's why today, for example, in AI, the number of models which are there are so high. That is why you know that many of them may fail. The few will succeed. That's why you have to worry about that sector at this point of time. So how do you look at gold and silver? People have asked us, this is a sector where there's no dividend, there's no cash flow, there is no earnings. So, you know, the people look at S&P to gold, Nifty to gold, Nifty to silver, S&P to silver, they divide these ratios. That ratio told us to buy in 2022 and told us to sell in 2025. After that, it shot up. But recent fall was very much in line with our framework that gold and silver had become very, very costly compared to equity. And that's the reason. Actually, if you had done a different analysis, oil had become very, very cheap compared to gold and silver. Of course, oil cannot be bought very easily. But oil had become very, very cheap. At some point of time in January 2026, if you had looked at oil to gold ratio, it had actually become very, very cheap. And that actually showed that you had to buy oil at that point of time. So in different years, you will have different asset classes doing very well. So if you pick the asset class which is doing extremely badly, put money in that asset class, you have a better chance of making money. Is it easy? No, because you will be one of the few people doing it. So if, for example, that is a challenge actually in investing. And so looking at valuations and which are the companies, which are the sectors doing very badly is very useful for cycle investing. Take today, no one is willing to look at Warren Buffett, but Warren Buffett, what he has been doing quietly is he's been increasing his cash level. The amount of cash he has in his balance sheet is the highest ever in his entire career. He has $400 billion of cash. And you know the US market is pretty overvalued. He's been patient. So he's just sitting on this cash. So because he is not able to see any value in US. And that is something which is very evident at this point of time. So if you look at it, at this point of time, there's nothing which is cheap, unfortunately. So that's why what you have to do is you have to invest in fixed income. You can consider specialized investment funds. You can do asset allocation kind of funds. You can do all these kind of funds. And these kind of funds are not kind of funds where you're going to be able to make big money. But that is the only way you can do it at this point of time, because there is not much choice at this point of time. Because for a cheap asset class, what are the asset classes which has done extremely badly? Japanese government bonds have done very badly. You can't invest in Japanese government bonds. Otherwise, if you look at it, there are hardly anything which is done badly at this point of time. So that's why the challenge at this point of time is nothing is done badly. That's why you have to operate in that boring period where you're not, as Howard Marks says, there are times when you're trying to make money. There are times when you're trying not to lose money. You're more in a framework at this point of time where you're trying not to lose money. That is why the best asset classes today are hybrid, asset allocation, fixed income, specialized investment funds, etc. And that is what we believe in at this point of time. And so our takeaways at this point of time are very simple. You have to assess peak and bottom of the cycle. You will never get it accurate, but you will be able to judge. If everyone is looking at it at one point of time, you know you're at the peak, you're at the bottom. It may take time. Crashes happen when asset classes become overvalued. Today, Korea, Taiwan, US. For Korea and Taiwan market cap to cross India looks to me that Korea and Taiwan are looking very, very much costlier. Today there are very few asset classes at the bottom. So the goal of attending the Alpha Summit is to actually try not to lose money. It is not trying to make too much money. At times the goal of an Alpha Summit has to be to try to not lose money so that you have the money to invest when the market's correct. And that can be the goal of the Alpha Summit at this point of time. So that's why over the last 2.5 years, we have been trying domestically, asset allocation is the way forward. And we believe higher debt allocation is the way to go. That is just to protect capital. That's where we have. So thank you very much for hearing me patiently. I think we have some time to take up questions.
We have the floor open now for a couple of questions. The gentleman right there, please.
Good morning, Mr. Naren. Arjun from Everguard Life Ventures. My question to you, if you were to design a portfolio for the next 10 years, what would be the biggest change you make today away from the traditional kind of asset allocation that has been practiced?
I think that the first job is to try to convince people you will make lesser money than what you will make in the last 10 years. That's been the biggest challenge actually. See, if you look at the last 10 years or last 5 years in particular, take Bombay real estate, take Delhi real estate, take gold, take silver, take Indian equities, everything has delivered very good returns. So the biggest job, if you ask me, is to try to convince people you are not going to make that kind of money, that the kind of returns that people have made in the last 5 years, that much return is not likely in the next 5 to 10 years. Whatever had to go up substantially has gone up. If you look at Worli real estate or Bandra real estate or Gurgaon real estate, it's not cheap at this point of time. Gold, silver has also gone up. So how to convince people that you're going to be in a moderate return environment has been the biggest job. Not only moderate return, there's possibility of downside also. So how to convince that to people has been the biggest job that we have. And to people have come to a conclusion in the last 13 years that the risk in equity market is close to zero of downside. How to convince that? These are the challenges that we are having at this point of time. Second, suddenly today people have come to a conclusion, people want to invest globally. It's not that global investing today is risk-free at this point of time. Rupee has depreciated too much. So what if rupee appreciates? Then you're not going to make the same markets. Global markets are also not cheap. So this is the biggest thing if you ask me.
Thank you.
Hi Naren, this is Kamlesh Shroff. Just wanted to quickly ask, what's your view? FI has been unpredictable or probably predictably selling over the last 1 year span. What do you foresee the way forward on this? And what are the reasons that you would attribute to their consistent selling?
See, actually what happened was they never used to invest in Korea and Taiwan because they were very, very slow growing markets, particularly Korea. So they used to say, why should I invest in Korea? Korea profits don't go up, India profits go up 10%, let's invest in India. Suddenly that DRAM prices shot up, that these two companies, SK Hynix and Samsung, suddenly started to show huge profit growth. India continues to grow at the way it used to grow, but India, the kind of companies that India have, the profits can't grow up 50%, 100%, etc. So suddenly they realized that this SK Hynix and Samsung profit growth is going to be 100, 200, 300, 400%, which India can't give. And they were all underinvested in these companies. So they had to sell India in an emerging market portfolio to buy SK Hynix and Samsung. Today, SK Hynix and Samsung profits are higher than India. Indian BSE Sensex profit and SK Hynix profit is the same. I think SK Hynix is higher. Similar is the case with Samsung. So they've been caught with this situation, and till this DRAM prices keep going up, the profits of SK Hynix and Samsung are going to be so high that this is a problem that emerging market funds are seeing. Will it last forever? Answer is no. Can it last for the next 6 months to 1 year? The answer is yes. So if I look at a cycle, I think clearly the Korea and Taiwan cycle is more overextended. But can we predict how long that cycle will last? India is not cheap, but clearly the Korea-Taiwan cycle is more overextended. And at one point they will come back. But the past experience has been whenever anything becomes overvalued, everything first becomes fairly valued, then India may do well. In between, there can be a tougher period.
Yeah, hi Naren. This is
Hi.
Jaisal.
Hi.
Hi. I just had a question. What are your thoughts about the role technology has played in the way markets have moved globally? Like US and other markets, we see a lot of these tech companies now building up. And what is it that we would need to do in India to, make sure that even our economy grows driven by technology?
So I think we worry about it a lot, and one optimist view I give you. The optimist view is that we never made semiconductors, still we were part of many of these chains. We never made PCs, we still did software for Y2K. We never made mobile phones, but we still did enough in software there. We never made cloud architecture, cloud hardware, but we still did enough in cloud computing, this thing. So the nowhere in the last 30, 40 years have been part of any hardware chain. It was always Korea, Taiwan, and US and Japan, which has been part of. We never made fax machines. We never made Xerox machines end to end. So, but at the same time, the services which followed them, we were always involved in it. So that is the optimist view. The pessimist view is that AI is going to take away our services job. Now, which of these two will happen, I do not know. But in your sector, pharma, I think we are again not there in some of the cutting edge pharma, whereas in generics we were very strong. So there are challenges ahead, and that is one of the reasons why premium valuations to be given to Indian companies is not something that FIs are comfortable doing, whereas they are willing to give premium valuations to SpaceX and Anthropic and OpenAI and all these companies. This is the challenge that we are having, and this is something which we have to worry about. But at the same time, Indians have always been dynamic, that they come into the services sector, somehow we do well. We are still hopeful somewhere we'll find a role in services. That's the positive we are hoping for.
I think that's all we have time for, unfortunately. Thank you so much, Mr. Naren.